the best of Money Matters. Market View on Money FM 89.3.
You're listening to Money FM 89.3, and it's now time for Market View, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and companies to watch to help you better position your portfolios. I'm Alexandra Parada. The SDI closed up at 0.3% at 4,269 points. Looking at corporate news, GuocoLand reported a 48% drop in half-year net profit to $32.4 million, down from $62.4 million, even as revenue rose 20%, weighed down by losses in China. In hospitality, Shangri-La Asia posted a net profit of $57.9 million, or 74.3 million Sing dollars, down 38.7% a year ago, while revenue remained steady at $1.3 billion, highlighting margin pressures. Across Asia, Japan's industrial output fell 1.6% in July, with automobile production down 6.7%, while Tokyo food prices rose 7.4% year-on-year, leaving the Bank of Japan in a challenging position. Globally, Nvidia forecast around $69 billion in revenue for its fiscal third quarter, meeting average Wall Street estimates, but falling short of the most bullish projections after 2 years of AI-driven growth. Now, for more market moves and views, joining us today is Benjamin Goh, Head of Research and Investor Education at SIAS. Hi, Benjamin. Welcome back to the show and happy Friday.
Hey, Alex. How's it going?
Doing great. Okay, Benjamin, let's start with the STI. So it opened at 4,259 points this morning. What's your take on the movement so far? Were there any surprises or notable drivers behind today's performance?
Well, the STI performance today pretty much mirrored the overnight U.S. market in that it closed up. So all sectors in the STI closed in the green except for accommodations and food service activities. A couple of standout names. You've got Keppel Corp and Seatrium, both closed at 3.2% and 2.2% respectively. So interestingly, both companies are in arbitration against each other, but they still went up today. The last thing was Propnex. So Propnex had an eye-popping 6.2% advance today, which is pretty interesting because its current market price is now pretty far ahead of its consensus target price.
Now, looking at some property news, GuocoLand just reported a 48% plunge in net profit to $32.4 million for the half year, which was down from over $62 million the year before. And this came despite revenue actually rising more than 20% to over $900 million. How should we interpret these results? Does it signal deeper structural risks tied to overseas expansion, or is this more of a short-term earnings setback?
Well, I think the key risk that the company highlighted was its expansion in China, and really this is showing up in the numbers. The profit drop was largely attributed to losses in China as well as higher accounting provisions for foreseeable losses in its Chinese property portfolio. So no, I don't think it's going to be a short-term issue because it's tied to China's ongoing deflationary pressures, its overall economic weakness, and its oversupply in the China hospitality sector. But there is a silver lining though, because since the company has already recognized the losses and have put in the accounting provisions, accounting-wise, the company has already taken the hit, so to speak. So any kind of improvement in the situation is going to be an upside catalyst for the company going forward.
But the company did explain that strong growth in Singapore was actually overshadowed by losses in China, where the property market has been under significant pressure. So should investors be looking at developers with heavier exposure to China as riskier plays, or focus on those with stronger domestic pipelines and recurring income?
Well, I think the stocks with China exposure certainly have a very different risk profile to stocks with largely Singapore exposure. But having said that, Singapore companies have got other challenges such as the ongoing inflationary pressures. You've got the global economic uncertainty. Singapore is very much dependent on external trade. But if you look at Singapore domestic developers, they are certainly responding to the changing landscape. So recently we've got a couple of launches in the core central region like River Green as well as Fernand Peak. Actually, I went to see the show units myself. They're pretty well done, good location. If you look at the numbers, they've gone down well with potential buyers. So a lot of take up. So yes, going forward, it could be a good idea to focus more on companies with largely domestic plays, at least in the developer sector.
Now, turning to hospitality, Shangri-La Asia reported a net profit of just under $58 million, or around 74 million Sing dollars for the first half, which is almost 40% lower than a year ago. What's interesting is that revenue was actually steady at just over $1 billion, or around 1.2 billion Sing dollars, but costs appear to have crept up, eating into margins. This does suggest that the post-pandemic recovery in travel and hotels may have peaked, with hotels now facing rising costs rather than enjoying demand tailwinds.
Well, the hospitality sector globally does face significant cost pressures, and we all know the big bullet points. There'll be things like rising employment costs, inflationary pressure on food and beverages. You've got persistent supply chain issues exacerbating the F&B prices, and then of course you've got rising energy costs. The actual term used by Shangri-La Asia when it released its results was cost normalization. I think that's very appropriate because, the inflationary cost pressures are not going to go away anytime soon, and is very much the new normal nowadays, hence cost normalization. I think we are at a point of, in the economic cycle where it's going to be very challenging for pure hospitality plays. And as you mentioned just now, yes, I think we should expect more headwinds rather than tailwinds.
But does this mean that the hospitality sector is still attractive, or should we remain cautious until we see clearer signs of sustained earnings growth?
Probably better to err on the side of caution and prudence. So a couple of big headline news that should be coming out in September. The U.S. Fed is likely to cut interest rates. This is despite still stubbornly high inflation in the U.S. as well as some other countries. Then you have got the impact of the Trump tariffs, disruptions of trade flows. I think that's going to show up more and more in the economic data. We have not really seen that in the first half data. A little bit coming in, probably more and more showing up. So all that is going to suggest that the inflationary pressures are here to stay and may even increase. So if you look at sectors such as hospitality, those are what we call cyclical sectors. I think those kind of sectors are going to feel the impact more than the other types of sectors.
Now, looking at the wider region, Japan's economy is facing mixed signals. Factory output fell more than expected in July, with automobile production plunging nearly 7% as U.S. tariffs took a toll. At the same time, inflation slowed slightly thanks to government subsidies, but food prices remain up, which was more than 7% year on year. What kind of spillover risks should we be watching? And could prolonged weakness in Japan dampen confidence in Asian equities?
Not really, I don't think so. Because if you look at historical price data for the Nikkei as well as other regional indices, Japanese equities tend to have a relatively low correlation with other Asian equities. I think 0.4 to 0.5 is relatively low. So whatever Japan is facing, it is unique to Japan only. So if just now you talked about the price of rice. The global rice prices have actually fallen since the 2024 peak. It's actually on a downward trend. But of course, that's totally different from the situation in Japan itself. So the price of rice in Japan is at record highs, and that's really because of the poor domestic harvest and high inflation in Japan itself. So that's bad for Japan, but doesn't really affect the rest of Asia. I think the biggest challenge for Asia is really the impact of U.S. tariffs on trade flows, the darkening economic growth situation, China slowdown, so on and so forth. So I think Japan is going to have that much of a spillover effect on Asia.
But the Bank of Japan is actually finding itself in a tricky position. They're weighing whether to continue raising rates after having ended its massive stimulus program last year. How should investors think about yen volatility now? Could it impact regional portfolios more than many might expect?
Well, there's certainly quite a few things happening that's making the yen more volatile. So I don't really know, but I was looking at the foreign exchange option prices. So if you use the FX option prices for yen USD or yen euro, the implied volatility of the yen is increasing. But the data shows that it's still far lower than its high in mid-April this year. And again, if you look at the typical, let's say, Singaporean investor, usually very limited exposure to yen-denominated assets. So the impact is probably not going to be that significant. But I think this is probably a very good question. So it's probably a good idea to, keep an eye on yen volatility as we head into the fourth quarter.
Now, globally, Nvidia grabbed headlines this week because after 2 years of explosive growth driven by the AI boom, the company gave a revenue forecast that was actually in line with Wall Street's average estimate. However, it was short of the most bullish expectations, which has raised some concerns that growth is finally starting to decelerate. Should we view this as a healthy cooling off period or an early warning sign that valuations have run too far?
Well, if you take a look at the revenue, it is actually the data center revenue that came in slightly below analyst expectations. So it came in at $41.1 billion. Analyst estimates had $41.2 billion. So that's really a less than 0.3% miss. So I think the valuation of tech stocks in general, typically on the high side, on the risk side, simply because of its higher upside potential, higher risk factors. And again, markets have been hitting historical high. So, some kind of pullback or profit taking is not going to be surprising, especially as we head into the end of the year and the impact of Trump's tariffs become more obvious in the data. The last time we had a big sell-off was in March this year. Could be a little bit too soon to see such a big correction. And, we had specific reasons for the March sell-off, really because Donald Trump kind of shocked the world with his, expensive tariff regime. Unlikely to see such a big correction anytime soon, but I think some profit taking as we head into the fourth quarter can be expected.
But still, Nvidia still remains the world's most valuable company with a market cap of more than $4 trillion or around 5 trillion Sing dollars. And CEO Jensen Huang insists the long-term AI opportunity is massive. He even spoke of 3 to 4 trillion in AI infrastructure spending by the end of the decade. So should investors continue to see Nvidia and the broader AI sector as a long-term growth story then, or not?
Well, I think the AI growth story is still largely intact, but if you refer back to Nvidia's guidance, they actually guided a really more down-to-earth growth going forward for the company. So gone are the days can we expect a 50% year-on-year growth, and really, arithmetic-wise, exponential growth can't go on forever. So given that this is a $4 trillion company, given the size, having a more down-to-earth growth, that's pretty reasonable. But again, zooming out, AI is not just about Nvidia. You also have got AI adjacent sectors such as energy, nuclear power, data storage, quantum computing is a big thing nowadays. And then you have got all these AI startups in China, so they're doing some really interesting tech over there. So even if Nvidia starts playing a smaller role in AI because of its lower growth rate, there are some really interesting companies in all those AI adjacent sectors that investors can take a look at.
And before we let you go, what else will you be looking at in the week ahead?
Next Friday, U.S. jobs report coming out for August. I think that's going to be a heavy hitter. So the last report and some anecdotal evidence coming out is that the U.S. labor market is cooling. So it'll be really interesting to see how much that has happened, how much it has cooled, or maybe there's a reversal. So that's the main thing to watch out for next week.
Well, thank you so much for joining me today, Benjamin.
Sure, it was my pleasure.
That was Benjamin Goh, Head of Research and Investor Education at SIAS. This has been Market View on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.